Welcome to the Daily Block, the top events from the past day in crypto and why they matter for traders. Strap in, because today's headlines read like a leveraged soup that just hit a blender. JP Morgan says perpetual futures deleveraging, not ETFs, caused the recent sell-off. JP Morgan's post-mortem points the finger at crypto-native leverage in perpetual futures. Open interest plunged by about $12 billion in Bitcoin and roughly $9 to $10 billion in Ether from October 10th to 17th. They highlight funding rate flips, collapsing open interest, and cross-margin cascades as the mechanic that turned a wobble into a washout, while spot ETFs and CME futures mostly stood on the sidelines taking whatever crumbs they could. The bank's data implies the market's heartbeat is still perp flows, not just ETF headlines. Why it matters for traders. Price moves are being amplified by leverage on exchanges, so monitoring funding rates, perp basis, and open interest gives earlier tradable signals than just ETF flows. Risk was counterpoint. JP Morgan's model may understate off-exchange, OTC, or institutional selling, and ETF redemptions can still matter on big volume days, so don't ignore both camps. Moving on to the market fallout. Market rout and mass liquidations. Bitcoin under $105,000, more than $1 billion liquidated. Bitcoin rolled over from October highs and plunged below $105,000, with on-chain data showing big reductions in long positions and long-term holder selling. Reported liquidations topped more than $1 billion, and the fear and greed index crashed into extreme fear, while gold's rally and geopolitical headlines sucked risk appetite out of the room. This looked like classic forced deleveraging, amplified by leverage and headlines colliding at the same time. Why it matters for traders. Expect choppy volatility and liquidation cascades. Position sizing, stop logic, and watching funding squeezes are essential right now. Risk counterpoint. Flash recoveries are possible as forced sellers clear, so mean reversion trades may pay off, but come with whipsaw risk. Next up, the ETF business flexes. BlackRock boasts fastest growing ETFs. IBI yet tops AUM, but saw outflows. BlackRock claims its digital assets ETPs and active ETFs ballooned from near zero in 2023 to $100 billion plus in AUM, with iShares Bitcoin Trust, IBIET, named the largest crypto ETF. However, flows flipped negative during the crash, and both BTC and ETH ETFs saw material outflows, reminding traders that ETFs can be both a structural bid and a source of redemption pressure. Even the distribution heavyweight narrative doesn't make them immune to price-driven redemptions. Why it matters for traders. ETFs are now big liquidity sources and sinks, so ETF flow prints can damp or reinforce volatility and should be tracked as part of your flow model. Risk counterpoint. ETF redemptions often pale versus perp deleveraging during fast moves, so ETFs are necessary but not sufficient to explain every price action. Next, VanEck files for a Lido staked ETH ETF, first mover on liquid staking ETF idea. VanEck filed an S1 to register a Lido staked Ether ETF that would track STETH via a market vector benchmark, effectively wrapping liquid staking token exposure into an SEC-regulated product. That would be the first attempt to give institutional buyers regulated access to staking yield without the custody headaches of direct validators. If approved, it creates another institutional on-ramp and a cleaner channel for ETH staking demand. Why it matters for traders. Approval would be a structural demand source for STETH and Lido, potentially tightening supply and creating a yield-sensitive bid into ETH-related instruments. Risk counterpoint. SEC approval is not guaranteed, and basis risk between STETH and ETH can create tracking errors and arbitrage opportunities that add volatility. Shifting to Asia. Huobi founder, Li Lin assembling a $1 billion institutional Ethereum trust. Li Lin, founder of Huobi and Avenir Capital, is reportedly building a $1 billion Ethereum trust backed by prominent Asian investors and early Chinese ETH holders, with accumulation routed through a NASDAQ-listed shell. The idea is coordinated OTC accumulation and regulated access for institutions that prefer pooled custody and trust structures. If real, it's a concentrated buying program that could remove material ETH supply from the market. Why it matters for traders. Large coordinated OTC accumulation can create a multi-week buying bid and reduce free float, so watch custody inflows and whale wallet activity for accumulation signals. Risk of counterpoint. Paper announcements can precede deal cooling or staggered execution, and big trusts can also offload into rallies, so timing is not guaranteed. Next story. Tempo raises $500 million at a $5 billion valuation. Dankrad Feist joins. Tempo, a high-speed, Ethereum-compatible Layer 1 built for payments and settlements, closed a $500 million Series A, led by Stripe and Paradigm, and hired Dankrad Feist, the core engineer behind dank sharding. The team claims institutional partners, including OpenAI, Visa, and banks for settlement rails, which if true could accelerate real-world payments use cases on a new L1. That kind of strategic capital plus bleeding-edge engineering talent makes this project a serious infra bet. Why it matters for traders: if Tempo delivers practical payments integrations, capital and developer attention could rotate into payments L1s and infra tokens, creating speculative flows in related ecosystems. Risk counterpoint: high valuations and optimistic partnerships do not equal product-market fit, and integration timelines for banks and big partners are notoriously slow. Japan's megabanks plan a yen-pegged stablecoin rollout before year-end. Nikkei reports Mitsubishi UFJ, Sumitomo Mitsui, and Mizuho are collaborating on a yen-backed stablecoin for internal settlements using fintech Progmat's system, with plans to expand into US dollar versions later. The rollout targets reduced remittance costs and internal liquidity efficiencies, and aims for a proof of concept and rollout by year-end. Bank-issued stablecoins for major incumbents would be a massive step toward tokenized fiat rails in APAC. Why it matters for traders: institutional bank stablecoins create lower-risk rails for fiat on- and off-ramps, speeding fiat crypto flows and potentially enabling faster capital rotation for traders in the region. Risk counterpoint: regulatory scrutiny, internal bank compliance, and interoperability hurdles can delay rollouts or limit initial use cases to closed-loop settlements. Finally, Firedancer, Jump Crypto's new Solana validator client, could boost throughput and resilience. Firedancer is a C++ validator client built by Jump Crypto, designed with multi-threading and parallelism to juice throughput and add client diversity on Solana. If widely adopted, it could reduce bottlenecks, improve reliability, and push effective transactions per second higher, while adoption will be gradual through hybrid testnets and phased rollouts like Frankendancer. More client diversity plus performance gains is a legitimate infrastructure upgrade for Solana's narrative. Why it matters for traders: better throughput and reliability increase on-chain utility, and could be a bullish structural catalyst for Solana apps and SOL liquidity if adoption is real. Risk/counterpoint: engineering promises often face mainnet surprises, and adoption depends on validators switching clients and the ecosystem trusting stability under live stress. Quick note on the stuff we left out, so you don't chase every shiny presale. Vitalik's efficiency ratio for ZK and FHE, Telegram native perpetuals, a new hardware wallet, and a tsunami of presale meme coins can all pump hard, but come with hair-on-fire risk. They're fun to watch, lethal to average into without strict risk controls. That's the digest. If you like the rundown and want daily chaos compressed into useful trade signals, subscribe for regular hits of news, funding rate ticks, and on-chain sleuthing. No hype, just the flows that actually move prices. That's today in crypto, where the gains are imaginary and the pain is real.